Hey everybody, it's Patrick Moore here with my video on 3 keys to good small business tax planning. And what I'm talking about today is not an individual strategy. It's about building a framework to help you separate the good strategies from the bad strategies in your life. Because I think that a thing that I think we're all guilty of is hearing about this cool new strategy and saying, "Oh, this sounds great for me. I got to do it." But we do that in a vacuum, and we don't do it when we take the rest of our life into account and try and build something that helps us actually have a framework to separate the good from the bad and get the best long-term outcomes. So that when you hear about a strategy, you can say, "Oh, this is why it's good for me. This is why it's bad for me." And so that's what we're going to talk about today. Now, before we get into that, a thing to know is that this is general tax information. It's not personalized advice. And we are going to be doing some projections into the future, none of which are guaranteed. They're just used to kind of proxy if something is a good or bad decision, generally. Now, getting started, I want to ask you a question that is, do you think it would be a good idea to know the tax consequences of a transaction before you execute said transaction? If the answer is yes, this is the right video for you to watch. If the answer is no, probably time just to X out and move on, right? I hope the answer is yes, because I think it's fairly self-explanatory that taxes affect just about every financial decision that you make. And with that, what's the problem we all face with our tax planning? Well, the reality is that we're typically reactive when we start. We wait until the end of the year or after something has already happened, and we're like, "Oh, it's February. I need to get all my tax stuff together. My bookkeeper's got everything closed. Oh crap, I owe that much money? What can I do to save money on taxes?" And that's the absolute worst way to do it, because after the year ends, there's quite simply less strategies available for you to pursue. And it also leads to a rushed, stressful environment. So the problem with reactive tax planning, I think I've boiled down to about 3. Is that A, it happens too late. There's simply less strategies out there that you can make use of than if you had planned properly. The second is because of that, and because of that stress, people tend to make poor decisions when they're looking at that tax number in the face and they were unprepared for it. Third is that it leads to you making short-term decisions because of that. If you're looking in April of 2023 to find money to save on 2022 taxes, the reality is you care about those 2022 taxes. You don't care about maximizing the next 10 years of your income and net worth because you're focused on the past. So a quick example of kind of what reactive tax planning may cost you is, do you think Amazon waits until the end of the year to plan for taxes? Now, I'm not saying everybody on this call is going to be the size of Amazon, right? But if you look at it, here's an example of what good tax planning looks like. In 2018, all feelings aside, right? It's good planning. Amazon made $11 billion, and they actually got a federal tax credit. I think it was about $129 million. That link has the exact details on it, but about $130 million they made back in tax credits, even though they made $11 billion. Now, looking at that, what it says is that's what good tax planning is worth. And you're not Amazon, right? It's going to look a little bit different, but I would about guarantee everybody's paying a higher percentage in their taxes than that. And you can't get a tax credit on, $11 billion unless there's some very specific things going on, but you can plan better. And the question becomes, how do we do that? And I think the answer is developing a framework to make those right decisions. And just like there's 3 problems with reactive tax planning, there are 3 key features in my mind of a good tax plan. The first is that it's proactive. The second, and this may sound, you may think this should be taken for granted, is that it's legal. The third is that it maximizes your lifetime benefits over your short-term benefits. And so the first feature that I'd like to talk about is a proactive tax plan. Put simply, that simply means weighing the pros and cons of a decision before it happens. And it also means looking at everything at once to see how that one decision may trickle out into 3 or 4 impacts rather than just the one that you thought would be impacted. And I think there's really 2 key ways this comes into account. It's with your total income taxes. So if you're in 2023, it's better to plan for 2023 in January of 2023 than it is January of 2024. And it also would be if you're contemplating a sale of the business, you're going to have more options and strategies available before you sign anything rather than after. And on that note, there's a lot you can do there, but that's just simply another video. We don't have time to get in all of that, and I'll probably come out with one sometime in the future about actually sale planning. Now, what does the value of being proactive look like? Why is this important? Why is it one of the 3 key features? Well, I'm going to give you an example here of a business owner. They're 45, they're married, they're in Georgia, and they made $500,000 last year. Well, looking in the LLC, which is how most people start, right? They would have paid about $162,000 in taxes. And what happens is most people start, they're not making a ton of money. They're looking at it and they're like, taxes don't really matter yet. And then they get that first year where they make a lot of money and they look up and they're like, oh, I owe how much money? But at that point, it's too late, right? Now, what happens next is then they start looking at ideas. And one of the first ideas I think everyone hears is about forming an S Corp. Some pros, some cons, right? But in this example, it could work. Now, the problem here is that the S Corp saves about $28,000 in taxes. But if you're looking at it at the end of the year, is the S Corp is only allowable for the first 2 months and 15 days for you to make that election, meaning you have to have that in by March 15th for you to become an S Corp for the year. So if you're looking up in January of 2024 for your 2023 taxes, the S Corp's not going to help you. Now, likewise, as you look here in that second example, in the S Corp, the person is paying themselves $60,000 in salary, which is also very common. People tend to push their salaries way down in S Corps because they think that it's the smart way to do it, even though they're not following what's called the reasonable compensation rules. However, if we look at this and then say, okay, what if we increased our W-2 salary? It would also save another $2,000 in taxes there just by making that simple change and being proactive. And just like the S Corp, you can't go back and amend your W-2s after the end of the year. So this is just an example of not doing anything special. It's just going before, analyzing your options in the future, and figuring out what's going to be best. Now, the second thing, and I think people probably laughed when you were watching this, and it's like, hey, keep it legal, right? But sometimes you hit a wall. You got that stress going on. You're like, how can I save taxes? How can I save taxes? And it leads to you making wrong decisions. But the reality is, if you're doing good tax planning, there's going to become a point where you not only can't, but you don't want to deduct any more in taxes because you want to, save that money and invest it into the future where you can maybe get some tax savings in the future. But when you're scrambling, it can lead to making poor decisions. And when we talk about doing things that may not be legal, not only is it unethical, illegal tax decisions result in significant tax penalties, which probably will result in you owing more than you owed in the first place when and if you get caught. That doesn't mean that you can't try to plan for those lower taxes, but there is a line to making those decisions. And here's just a few examples of what it looks like. Negligence, accuracy related, 20% penalty. Civil fraud, 75% penalty. Criminal tax fraud or evasion, not only a penalty and a stiff one, but jail, I think, is up to 5 years. So that's just an example of why you should keep it legal, because that also will just keep you making better decisions into the future. Now, the most important one I want to show you, well, actually, I probably shouldn't say that for legal, right? The most important one is they keep it legal. But my favorite part of this is emphasizing the lifetime savings over short-term savings. Because too often when you're scrambling, like I've said, you look up and you're like, what can I do to save this year? But you're not looking into the future. Because in my opinion, a good tax plan integrates into a financial plan that puts you in a better place long term. And I think you can boil it down into one option here. What's worth more to you? Is it paying less in taxes, or is it making more money? Typically, you would think number one is in the service of number two. But when you put the cart before the horse and are just solely focused on saving money on taxes, that may not always be the case, so you need to be very careful. And here's what that turns into, right? That short-termism. When you're looking at it and you tell yourself, oh, that's a write-off, or oh, that's great tax planning. I can save money on taxes here. But then you look up and you didn't really need what you're talking about. That's a problem. that short-termism can really affect you in the long term. Because the most important secret to long-term financial success is owning appreciating assets that go up in value over time and not having to sell them. When you're just chasing those tax deductions and investing in depreciating assets, over the long term, you not only might be, you will be worse off from a financial perspective. So here's our example. You're a business owner, it's November, you're in the highest tax bracket, and you have $60,000 and you want to lower your taxes. What can you do? Well, to illustrate this point, we've got three options we're looking at today. The first is to buy a truck that's going to go down in value 20% per year, but it's going to give you that huge tax deduction year one. You're going to sell it year six, and you're going to reinvest it in an investment account and get 7% a year. The second is that you're going to pay taxes on that money, just take your lump and invest that money in appreciating assets at a 7% return again. The third option is where you're going to get the best of both worlds. You're going to get a tax deduction today, and you're going to invest that money and get 7% return in a 401k. So here's what these options look like when you kind of compare them over time. The main one I want you to compare is the red bar and the blue bar, which are the truck and the brokerage account. You can see in year one, the truck comes out ahead because you get that full deduction and you've still got the $48,000 truck. However, if you look at the brokerage account, it has about $40,000 in it because you paid about $22,000 in taxes, but it did grow a little bit year one. As you move forward, though, and look at year five, and that crossover happens before year five, you can see that the truck only has $20,000 and the brokerage account is worth $49,000 because that continues to go up in value rather than depreciating. And then if we fast forward all the way to year 20, you can see the truck has about $43,000 because remember we invested that money in year six. The brokerage account has $107,000, right around there. And the 401k has about $232,000. So you can see that if you can get the tax deduction and invest the money in appreciating assets, that's the best of both worlds. But this illustrates the point of if you're focusing on a short-term decision, it could negatively impact your finances when just paying the taxes may be the better financial decision. So if I had to summarize this video in 3 key points, it'd be, hey, if you want to do good tax planning, build a framework that's proactive, legal, and helps you emphasize the long-term over short-term decisions. And at the end of the day, it just comes down to you, right? Which game would you rather play? Do you love that last-minute scramble? I know I don't. I'm pretty sure you don't. Or would you rather have a plan? If you'd rather have a plan, your framework may be a little bit different than mine, right? But by having that framework, it's going to help you maximize your long-term wealth. So if you enjoyed this video, my offer to you is that I do a free strategy session to answer pressing questions at no cost or obligation. It's just a 20-minute call. And then if it makes sense, we'll do an hour-long call after that. And at the very least, if you're not going to do this on your own, chat with your CPA and see if you have the resources to create a good tax planning framework. So I hope you have a good rest of the day, and I hope you enjoyed the video.